Hello, and welcome to the paper's exclusive video interview series where we dive into key industry trends, developments, and groundbreaking initiatives shaping the future. I'm Juana Ifrim, and I'm very pleased to be joined by Giorgio Andreoli, Director General at the European Payments Council. Giorgio, it's great to see you, and thank you ever so much for taking the time to speak with us about one of the most important industry initiatives, the SEPA Payment Account Access Scheme. Thank you so much for joining.
First of all, thank you so much for inviting me.
And let us first provide a little bit of a context. So in 2021, the European Payments Council was formally invited by the European Retail Payments Board to take up the role of scheme manager of a SEPA API access scheme in relation to payment accounts, later renamed SEPA Payment Account Access Scheme, or SPAA. The SPAA scheme aims to drive open payments in the EU in a way that unlocks and creates value, allowing a fair distribution of value and risk among participants. Supported by European authorities, the SPAA scheme is poised to become a pivotal component of the European open banking ecosystem, encouraging innovation and broad market adoption. To date, the scheme has attracted 5 participants, marking an early step towards broader implementation across the financial sector. So, Giorgio, can you please let us know what is driving the need for the SEPA Payment Account Access Scheme, and how does it differ from PSD2 in addressing market demands? If you look at, for instance, for merchants, for SMEs, and for corporates, and maybe what are the gaps PSD2 left unaddressed?
Yes, sure. Thank you for asking. Well, PSD2 has been a very ambitious step forward by the European Commission and the co-legislators. For example, it succeeded in mandating strong customer authentication, which was successful in reducing fraud. However, the open banking part of PSD2, namely the so-called access to account part, was definitely less successful, where most of the ASPSPs or asset holders in SPA terminology perceived it as a pure compliance obligation without any real business model behind. Well, the European Commission first and the ERPB later. The ERPB is the European Retail Payment Board, high-level organization, recognized that a scheme-based approach was called for to secure a fair distribution of value and risk across the value chain. So at that point in time, the EPC was invited by the ERPB to take the role of a scheme manager for this new scheme. Let's remember what a scheme is. Basically, a scheme is a multilateral contractual obligation that is agreed on a voluntary basis by scheme participants and sits on top of regulatory obligation. This is what the EPC produces. And so the SPA schemes effectively goes beyond PSD2 in defining multilateral business conditions that cater for a fair distribution of value and risk across the value chain. So basically, this scheme allows, in a few words, for a viable business model for open banking for all stakeholders.
Thank you so much. And if you look at your discussions with market participants, why are dynamic recurring payments the most requested feature by merchants? I mean, what are the benefits these payments, and how SPA is positioned to deliver a sustainable solution, and how can SPA basically leverage insights from the success of variable recurring payments in the UK?
The variable recurring payments, or dynamic recurring payments as they are nominated in SPA, actually is a very flexible feature that supports a wide range of use cases. In particular, but not exclusively in the e-commerce domain, for example, subscription services, or let's say more in general, modern a more modern approach than direct debit, which has been one of the big hit of the past, in the SEPA area, and is still widely used in many countries. Dynamic recurrent payments definitely allow for a new approach to that, which is especially useful and interesting for younger generation that do not understand anymore a way to pay in which you are not asked or you don't provide any authorization apart from the initial mandate. More in general, dynamic recurring payments improve merchant cash flow management by providing a greater support over payments collections, for example, and provide an enhanced customer experience. As EPC, we don't enter into the detail of the use cases. We know that it is an extremely flexible and innovative approach. We believe we built solid rails for that. Then inventing new use cases and new services is up to the market, not to the EPC for that.
Thank you so much. And if you look at banks, and I know that you get this question a lot, what are the commercial benefits for banks when adopting SPA, and how can they maybe justify it within an already busy roadmap? Because we already have instant payments, we have PSD3, we have PSR, and why would they adopt SPA now instead of maybe waiting for PSD3, PSR to take full effect? So are there any maybe like competitive advantage for early adopters?
Well, that's of course one of the key questions around the SPA, but is in general one of the key questions around any new scheme or any new product. What we believe, and this has been one of the initial assumptions, is that the SPA can generate additional revenue streams for both the ASPSPs and the TPPs, or asset holders and asset brokers in SPA terminology. Actually, it's not up to the EPC to make a market forecast, but we see many market analysts foresee that there will be a new investment cycle for open banking that could start in the EEA, the European Economic Area, as early as of 2026 or 25, even due to instant payments becoming the new normal. So being really mainstream in continental Europe, the technical obsolescence of past PSD2 infrastructures, and the need to comply with the new payment services regulation, which should enter in force at the end of next year. Basically, in this general framework, SPA will allow the banks, the ASPSPs, to move from a pure compliance investment, so pure cost, to open banking monetization, so the possibility to also extract a revenue stream from that. This is in short the answer.
And what do you see as the most significant achievements of SPA so far? Do you think it's heading in the right direction right now, or maybe are there things that we should look forward to in the near future?
Well, SPA for the EPC has been a prime time for many things. We already achieved a number of significant achievements, but there is still a lot of work to do. Let's list the first achievements we had. In June 2023, we issued the version 1.1 of the scheme of the SPA scheme rulebook. In November 2023, there has been a major milestone with the approval and the publication of the version 1.0 of the SPA default fees, so meaning the standard business model for SPA, including fees for remunerating the asset holders from the asset broker side. In December, we had the first participants. As you mentioned before, we now currently have 5 participants to the scheme. And in May this year, we launched a call for interest for a tactical SPA pilot. What we expect to happen in the future? Well, primarily and most importantly, our objective is to move to a live market phase for the scheme. So 5 participants is not enough, even because so far we only have asset brokers as participants. We hope and we expect to have the first asset holders to participate. And also, equally important is to fully align SPAA with the future PSD3 and payment services regulation once the final text for them will be known. These are, I would say, the most important objectives for the future.
Thank you. And I know that we already discussed a bit about it, but if we look right now at the industry, there are many emerging pan-European payment initiatives, and the evolving regulatory landscape, looking at the evolving regulatory landscape, which is, huge right now. How should banks prioritize their focus and investments, because there are investments as well, to enhance payment offerings, meet regulatory demands, and achieve strong commercial outcomes? And I think the question is also, how can banks leverage their existing investments right now, let's say in PSD2 open banking, to support these goals?
Yeah, this is again a key question, and it's not easy to answer. By the way, this is fully into the remit of the private decisions of each individual EPC member and scheme participant. But I would say, highlighting some of the major points, SPA, as we mentioned before, allows to leverage regulatory investments in PSD2 access to account and in instant payments, allowing asset holders to extract revenues, potentially to extract the revenue streams from those investments, which previously were only for compliance purposes. So in few words, SPA is a way to basically transform a pure compliance investment into a potential revenue stream. At least this is what we allow with our default fees. That said, what we did this in a way that, as far as it was possible on our side, this creates fair distribution of value and risk across the value chain, and value for all stakeholders, not just banks and TPPs, but also and primarily end users, meaning merchants and individual users, which will have more choice, more freedom, and more innovative use cases and services. This was our goal. Then, if it all will work, it's again an individual decision of all participants that need to make their own business case, their own evaluation, and evaluate these potential investments vis-a-vis other potential investments and choices.
Thank you. And to recap, so the SPA scheme has a final rulebook at the moment, a commercial model, and is already supported by technical standardization initiatives such as the Berlin Group's Open Finance API framework, and key open banking players such as Tink, Token, TrueLayer, and Go Cardless. Looking down the line, does SEPA have what it needs to succeed, or is there anything still missing right now, apart from what you mentioned already?
Yeah, of course, we believe we put a lot of ingredients into this now, and the right ones, definitely. If this will result into a good receipt, it's not only or exclusively up to the EPC, or to say that it's up to the cook that will have to not to do that. Said in other words, we believe we built a very solid rails, paving the way for success. But neither the European Commission nor the EPC can produce the trains running over those rails. This is up to private initiative and up to the market. We believe the intervention of the market and the entrepreneurial initiatives are the key ingredient still missing to make it a success, and nobody can substitute the market, if not the market itself, let's say.
All right. Thank you so much. This is really exciting, Giorgio, and we really look forward to seeing how things develop moving forward, and hopefully we'll have a chat again soon. But in the meantime, thank you so much for your time and insights.
Thank you a lot. Have a good day.
Thank you, you too.